Welcome back, traders and investors. I'm on the line with Justin Pulitzer. He's a swing trader, a veteran in the markets. Justin, how you doing today?
Good, and yourself?
Good, good. Could you just give us a little bit of your background, your education and background, and how you end up in these crazy markets?
Yeah, I guess I haven't been on the show since the summer, so I guess everyone needs a refresher. Born and raised in New York, I have degrees in finance and marketing from NYU Stern School of Business. I've been a proprietary trader really since I was a teenager when I was legally allowed to open up a trade account, and have done it professionally since 2007. When I say professionally, I mean full-time as my, what pays the bills.
Okay, all right. And how'd you develop your trading strategies?
Over years of, I guess trial and error research as to what strategies work. I mean, I have different strategies for different markets. How I'll trade a market that's post-crash is very different from how I'll trade a market in in momentum mode, as opposed to when it's sort of in a chop mode. I like to think of the market sort of basically how I like to trade stocks. I think of three things. I think about it in terms of its trend, buying and playing with the direction of, or selling in the direction of the major trend. I think a lot of people try to get too cute and try to catch every move in either direction, which is unrealistic, and I just try to play with the main trend. I also like to play in stocks where fundamentals are either continuing to be bullish as far as buying, or shorting when the fundamentals are deteriorating. And then the third pillar that I look at is the macro condition, meaning the overall condition of the market, and mainly having to do with credit. That's usually when markets get themselves into a lot of trouble, is when there's some type of a contraction in credit and the ability for people to be on margin.
Okay, so let's talk about the kind of market we're in now. How would you characterize it, and what trading style are you employing in what issues?
The market, as I see it currently, is in a bit of a funny place. It could be, it hasn't really shown its hand yet. It could be within what I consider a transition phase. It's been in a lot of consolidation. You've had a lot of responsive people playing in the market, and by responsive I mean, like, for example, if you take a look at yesterday's low, it was in SPY. It was to the tick the same low as 1216. So it also coincided. It was roughly, I think it jumped a little bit ahead of the 200-day moving average. But to me, that's no coincidence. And that, to me, tells me that short-term traders are still dominating the market. It isn't the institutional money. So I think what I'm really waiting to see with this consolidation in the market is when the initiative, either buyers or sellers, step in and take the market out of balance.
Okay, and we were just before we got on, we were talking, you had talked about, my comment about getting caught, going short through that 19 area. And I guess, and this is probably sometimes when, using the S&P futures and the rolling contracts, I had a different low. I had another, low about 3 or 4 points lower on the corresponding contract. Now, when I pull up the spider, I do see that it did match it to the T. So, following different instruments could give you different indicators, give you different results. You like the Momos though, and it seems last time you were on, we talked about different stocks. Apple, Facebook, Google, Priceline. One that hasn't reported yet, it's reporting on Thursday. I see trading up 71 cents. Twitter, you've made some good calls on that in the past, and what do you think of Twitter?
All right, so I don't know if you watch my YouTube channel, but I discuss all these Momo stocks and my broad market analysis on there, but I'm guessing you haven't because you're asking me on live. But my feeling on Twitter here is we're either going to see, when I had discussed with you what I thought was going to happen with Twitter, to me it was a no-brainer that it was going to be a rally up higher, and it wound up being a pretty solid rally that sustained itself. The current problem for me with Twitter is, on a relative basis, it's an expensive stock, but in terms of what some of these companies are getting in terms of multiples, it's not, and it's a unique property. I really kind of have to see the quarter this time before I make the decision. If it's bad, I think we're going to see 29s and possibly 25s. If it's good, I think it'll see 44, at least 44, which was the gap down high of day, and then probably could get a squeeze going up to 48. So I sort of feel like the second mouse here might be the one that gets the cheese. Playing either direction ahead of the print to me on this particular issue is a little bit more gambling. I would think that if you're going to play it, the way to do it would be through options and to do it with spreads and to do it in the sense that you're looking for the move either way, and then once you get that initial move, you go with it.
Okay. All right. So are you more inclined not to play the number and play the reaction, or you
Yeah,
know?
I'm inclined to wait. I'm inclined to kind of wait on the sidelines just this time with Twitter, see what they do, and that doesn't mean that I'm trying to couch it. It just to me that when people ask me how I play stocks, I basically am sort of playing the odds, like where I think, the probability will take me.
Mm-hmm.
And in this situation, I don't see anything that tells me in terms of odds where it is. If you're long Twitter and you want to play from the long side, this 35 area has been very important. The expected market maker move for the earnings is $4.24 on the snap, and into Friday expiration is $4.50, just a little under $4.59. So that's the risk range. My guess is that this will have some type of an outsized move, particularly if it's to the upside, and there will be kind of gas in the tank to play it that way. If you are playing it with options, though, know that that's the move, and you don't want to get banged out buying premium, and that's what's being priced in. So I think if you're playing long, you could play it long against the reference low, which was 34.62 between there and 35. And anything below there, I think you're looking at 29s. There's no support. I would be an absolute buyer down there if it gets that move to, play for a bounce for maybe a gap fill back up this time. And if it does have some momentum, if there is an initial pop that does take us back out of range, then I would be playing for continuation, like I said, for a move back up to the 44.58 level, and then back up to 48s. Possibly beyond.
Do you get anything from the open interest in the weekly options for Q's to trading? We have Nick Shaheen on, who trades the option markets quite a bit, and he kind of sees where things are being pinned. Do you pay much attention to the open interest in the weekly options?
I do. In some stocks, it works better than others. Like in Apple, it hasn't. It helped me actually for earnings this go round, just because there was a lot actually in February. But sometimes the intraday volume gets so large that it can kind of dwarf what the OI is, and I've even seen it switch intraday. But in Twitter, I'm seeing the high OI up at 40 seems to be. Let's see, 40 has high OI, 41. That's in the call side, and that kind of trails off above 45. And then in the put side, there's less. I mean, the OI is a little bit less, so I guess people are still thinking bullish. It starts picking up down to 37s through 36s, and 35 is really kind of where it starts trailing off. My thinking, though, with that the bullish sentiment in Twitter does concern me a little bit, because I know I've seen people on TV talking. They say the same, like I had said, that I do think it's a unique property. But the difference between myself and them is that they're in positions that they're underwater on, and I think they're kind of playing the hope game. I don't think there's been capitulation in Twitter, which makes me a little bit concerned. Like, I would love to have seen Twitter go into the print kissing those lows at 29, and that would be an absolute buy, or sitting right at 35, so you could do some type of a row right or right out trade. But I think that there's a lot of risk, honestly, in the stock both ways, and to me it's a little less clear. I do think that they need to do something. I think something will happen with that stock in terms of management. The management there has no confidence from Wall Street, and they're going to need to do something in terms of that.
I mean,
Yeah,
does it get any respect? I mean, it's meet or beat every quarter since it's IPO'd. I mean, now they're looking for some profit. I mean, from a fundamental standpoint, are you comfortable with the business model?
with Twitter.
Yeah.
I think their problem is monetization. I mean, if you look back, the model was, everyone wants to draw parallels to is Facebook, and it really took Facebook 2 quarters to kind of convince Wall Street that they were able to, to monetize the property. I remember when Zuck bought Instagram for $1 billion. Everyone thought it was, the consensus was that this kid, basically got a hold of daddy's credit card or whatever and was just going wild. And in retrospect, those that acquisition and some other ones seem like he was thrift shopping, pretty much Macklemore style. So this guy is proven, I think, himself to the street that he's able to monetize the business. I think Twitter just needs to figure out how they're going to do that. And the fact that they've been moving more and more to look like Facebook, I don't know if that's a good thing. I know like Microsoft tried doing that with their tablets. They tried to make their stores look like Apple stores. The thing was a complete failure. So I think really the key for Twitter is to realize that they're really sort of the new news media. They're, in my opinion, the new CNN. That's where people get their news, and you can highly customize what your stream is. I happen to like their business model. I happen to like I like the company and I like the business. I just want to see I want to see that they're able to monetize it.
Let's talk about Facebook here, and boy, I've been saving myself some money by not trading it as of late. Just this trading range from 74 to 78. Good numbers, 6 cent beat, no credit from the street. Can we stay in this? I mean, if you look at this going back to November here, and you take out a few blips here below 74, and then the breakout to the new all-time highs. I mean, this thing's been trading 74, 78 now for like almost 4 months. Are you looking for a breakout or a breakdown in Facebook?
I think that's going to depend a little bit on the broad market. I happen to believe in Facebook. I think that the story is good, and I think the stock can eventually get itself up to $100. The price action on the last earnings was that they had good numbers and that the stock couldn't go higher, so it had to go lower. This go around, they had what was perceived as bad numbers, although I thought they were pretty good numbers, and the stock could not hold lower. So if it can't hold lower, it should go higher. Like you said, though, it's just in this consolidation range. My business isn't really trying to anticipate which way it's going to go. It's to go with the move once it happens. So, either you're going to play for the breakdown or you're going to play for the breakout once we get out of the range. One thing that did concern me a little bit was that Facebook did fill the gap the last go round, and then right afterward it was like nonstop selling for like days and days on end, which to me told me that there was probably some institutional selling in there. I don't know if that's cleared out or not. It seems like it's stabilized, so maybe it has, and now they're just sort of waiting for people to come back in and bull it up. We saw the low that day was 72 on the earnings. That was where it hit on the snap. So I think if you sell puts as a long proxy that are 72 strikes or lower, you'll probably be able to stomach the volatility a little bit. But you are correct; it is in a range, and it has just been very, very choppy.
Okay, before we got a few minutes left here, we're on the line with Justin Pulitzer. He's a veteran swing trader of the markets. Let's just touch on a few quick issues here before we let you go. Google, not so great numbers, but they rallied the stock. Here is another stock that's in a trading range. Anything on Google?
Yeah, I mean, you might as well have just continued talking to me about Facebook.
Okay.
It's the same sort of story. It couldn't go down on numbers, so it should theoretically go higher. If you pull up your chart, this last low was a higher low than the last, and it's setting up for sort of a cockeyed inverse head and shoulders. If the stock can clear 543.93 to 545.41, then I think it will be a breakout of the of that pattern, and you probably will see 567s.
Okay. Apple, good earnings, good numbers, taking the stock up to a new all-time high, 120. Due for a little breather here, or what you looking at in Apple?
All right. So the story with Apple is it's a very large stock. It's the biggest, right? So I think that the problem for Apple has been the amount of people that are playing it bullishly. They all bought options. They all are in calls, and I think a lot of that sort of premium excess needs to be washed out of it. I don't necessarily know if that has to happen with price going lower, although with momentum stocks, when they can't go higher, they go lower. I tend to think Apple should go higher. It did make a slightly higher high than the last, although it was by a quarter. My thesis on Apple is if it can hold over that 119.40, or I guess now it's going to be 120, it can see 128.97, which is a big 1.618 Fibonacci extension from the prior peak to the low, and that's where that would terminate, back up there. Apple tends to be also like gold. Oddly enough, they like to respect technicals a lot. So I'm not sure what the time frame that happens in, but it probably should resolve higher if it wants to stay bullish. My cautionary area with Apple, I think that 117 to 115 area is an important buffer zone, so to speak. If you start getting below 115, the gap fill might be in play. If you take a look back a few days, a bunch of days back, I think it was on 12/1, there was like sort of a flash crash in Apple, and for me, that is the range that Apple needs to either be above or below. If it's above that range, it's bullish. If it's inside, it's sort of just range, and if it's below, it's a little bit more slippery and bearish.
Okay,
So,
besides all the the Momos and the big line big name stocks we talk about, any diamonds in the rough out there that whether they're big name stocks or whatever, is there anything that's been catching your eye as far as little bit ignored?
you've had a market that's really run a lot the last 2 years, and a lot of the diamonds are sort of polished stones sitting in the window at Tiffany at this point.
Okay, all right.
I do think you were talking about coal earlier. I think at some point, some of those stocks, and we're probably getting close, right, to that point where those stocks will wind up being a buy. I mean, they can't all go to zero. So, I think the trick with those will be to, if you have a weekend where you're not out at the movies or doing whatever, clubbing it up, right? Take a few minutes, go through some of these companies' balance sheets, particularly their statements of cash flows. Take a look at when their debt maturities are, how well they're able to cover them, and then pick a few of them. I did this back after the Enron disaster. Actually, this is one of the ways I analyze stocks, and I was combing through these. I was also fresher out of business school, so this stuff was a lot more like on the tip of my mind at the time. But I combed through some balance sheets, and I was able to figure out Williams was going to be a stock that could survive. And then I had bought into the stock, and I wound up selling calls against it for a while. And through that process, believe it or not, I wound up owning the stock for free, and wound up pumping it out at 38. So it worked out. That analysis worked out really well. I think if people are inclined, and I'm actually going to do this myself, start going through some of these coal stocks and some of these natural resource stocks, some of the oil stocks as well, and figuring out who's going to benefit from this lower oil and who can snap up properties cheap. Companies like Exxon will probably be able to snap up some of these shale plays for pennies on the dollar if they breach their debt covenants and go bankrupt.
Okay, anything really overvalued here? If we can't find things that are undervalued, anything that you're licking your chops on the short side?
Like I said, I really want to see how when the markets, if they start breaking down, correlations start moving to one. All these stocks start trading as an asset class. And I really want to see how the overall market handles itself before I, step prematurely ahead of the short. That has been a sort of Fargo-esque wood chipper, right? For a lot of people, there have been a lot of very smart people that have gotten themselves chopped up in terms of buying or trying to step in front of shorts. So if you're asking me what I think is overvalued and something that is on my eye, I've sort of been dipping the toe recently for the first time, actually in years, in TLT. I think that the Treasury story is getting really a little out of control. I think what's been my thesis on this is that, and I actually had put on a trade a couple of days ago with a put spread, and it was actually, believe it or not, the day of the top, and it wound up being the top so far, and it's working a little bit, but I mean it was sort of like a little bit of a bet. I had just bought 132 puts and sold the 127s against it. Usually I do put ratios, but I did this one as an even spread for March, so we'll see how that. I mean, so far it's working out, but you know, in the 2009 crash, the high of this was 120 in the 123s, and the recent reference high was 132. Yeah, I mean, the trend is that rates are going lower, and I think funds are playing the differential between European yields and the U.S., meaning they're shorting the bonds over there because their yields are so low, and they're buying the bonds here, which makes a lot of sense, right? I mean, the U.S. is a lot more credit worthy, in my opinion, than Spanish debt, for example. And I think that that's a trade. At some point, it'll unwind. These things always unwind fantastically, and funds blow up and such. But the markets can stay irrational longer than a lot of people can stay solvent, and that would be something that I think is overvalued, and at some point is going to be the trade of a century.
Okay, great comments there from Justin Pulitzer. He's a swing trader calling us from New York City, giving us his inputs on the markets. Thanks a lot, Justin. Have a good trading day. We'll talk to you again soon.
You too, Joel. Take it easy.